Did you know that age 59 and a half is one of the biggest financial milestones before retirement? But a lot of people kind of miss this because this is an age that is not tied to Social Security or Medicare. So people aren't really thinking about planning at this age. Yet, this is a great time for you to really set up yourself for success in retirement. Now, 59 and a half, a lot of people know this is when you can start taking distributions from your retirement accounts without having to pay any penalty. But a lot of people don't really think about the fact that this is when you can really start doing some planning because Social Security and Medicare are not far away. And many people are starting to think about their future retirement and just how many years they may have left in the tank at this point. So, I want to go over some of the kind of your key financial planning opportunities at this critical age. Now, my name is Scott Caulfield. I'm a CPA and CFA charter holder and the founder of Sophos Wealth Management. So let's start with the obvious one. We've got your chance for penalty free withdrawals from retirement accounts. So if you've got that 401k, IRA, 403b, if you are under 59 and a half and you take money out, other than just a few exclusions, you have to pay a 10% penalty. Once you hit that magic 59 and a half, you can take withdrawals on these accounts without paying that penalty. Now, keep in mind, unless this is a Roth, you are still going to owe taxes on this money, but being able to now tap this can kind of give us some levers to pull in terms of your overall financial planning. And because you're already so close to retirement, this becomes a critical age where we can really start doing some real planning work and take advantage of some opportunities. Now, one of the big ones a lot of people think about are Roth IRA conversions, especially if you're looking at retiring before you're going to take Social Security. A lot of people will have a trow income, so low income for a couple of years. That is a great opportunity many times to take Roth IRA conversions before Social Security kicks in and or before your RMDs kick in much further in the future. By doing these Roth conversions, you're able to kind of pay tax in a low tax year so that you kind of avoid that tax potentially in a future year by having that money in a Roth. Now, another big thing that happens at 59 and a half, I mean, it's already kind of been happening since 50, but this is a real chance to supercharge your retirement savings. So you get catch-up contributions. Those over age 50 can contribute an extra 7,500 into 401ks, and into IRAs, they can do an extra 1,000. And once you hit 60 to 63, right now, there is a super catch-up contribution. So you can put an extra $11,250 into your 401k if you're between the ages of 60 and 63. So that is a huge opportunity to kind of catch up on savings or get some extra money in that 401k if that's what you need. 59 and a half, also a great time to kind of start thinking through your Medicare and healthcare planning. So, if you're going to retire before age 65, so before you're eligible for Medicare, you definitely need to think about what you're going to do. Are you going to go on COBRA? Are you going to go on the Affordable Care Act? I think a lot of people who have been on private health insurance, who've been paid for by an employer, are not really ready for the sticker shock of just how expensive paying out of pocket can be. So, this is a good time to research your options for healthcare before Medicare kicks in, especially if you are looking at retiring early and will not be covered by a workplace. Now is also the time, if you haven't done so already, to really get working on your Social Security strategy. And if you've got a pension, strategizing around that. So I always encourage you to go get your Social Security statement from the Social Security Administration. It's got a lot of great information for you on there. It's going to show you your estimated Social Security at your different ages. It'll also show you kind of your past earnings record. You can kind of think through what it'll look like if assuming you continue to work before retirement. But this is really valuable in kind of getting that planning going. And then you can start thinking about take it early at age 62, or whether it makes sense to delay all the way to age 70. And I've done videos about this before. I really like thinking about it in terms of an internal rate of return. So, what is the rate of return on that decision to delay? It is deeply negative the first few years as you forego payments. And then after a certain amount of time, it becomes a positive break even before becoming a pretty attractive return. So, obviously, you're going to want to take into account your individual circumstances, but starting to think through that, I think, is really valuable, and doing it a few years ahead of time so you kind of have a game plan. And if you've got a pension, start thinking about, or at least incorporating that into your planning. Are you going to get a Annualized payment, is it gonna be kinda like an annuity? Do you have a lump sum option? How does that work into your overall planning and cash flow? What kind of returns do you think you can get on it? So, again, this is a great time to take that into account. Also, this is a great time to start thinking about your future RMDs. So, RMD ages have been bumping up and up and up and up. For a lot of people that are about to hit 59 and a half today, you most likely will not have an RMD until you are age 75, assuming no changes in the law. However, it's a good idea to start thinking about it and start kind of strategizing so that you can optimize your cash flow after tax and pay the least amount in taxes that you legally can. We want to kind of maximize your money, your enjoyment of it, or if your goal is to maximize it for future heirs. Either way, we want the smallest chunk going to the government that we can. Now, 59 and a half can also be a good opportunity to kind of look at your balance sheet. And if we've got any high interest debt, this might be a great opportunity to tackle it. So, because we can tap those retirement accounts without any penalty, if you've got high interest debt, that might be something you would consider. Let's say it's paying off a credit card. The only caveat there is, I always kind of cringe when people pay off debt from their retirement accounts because a lot of times they'll just rebuild that debt. So that kind of worries me. But I also hate seeing those exorbitant interest rates people have to pay. And if you are in that much debt, it could kind of be pretty crushing. So this could be an opportunity to take care of that and just kind of look at your overall situation. And finally, this is a chance to clean up your portfolio, your investment portfolios. A lot of people by this age have worked at a few different employers. They might have multiple 401ks, IRAs, rollover IRAs, kind of spread out 4 or 5 different accounts. Good opportunity to go ahead and consolidate those into, let's say, just your 401k and one rollover IRA. And then also to rebalance your portfolio and align it with your risk tolerance and goals. I mean, this is an age where you are getting close to retirement. A lot of people are maybe more aggressive than they otherwise would be or want to be as they're kind of getting close to retirement. But the goal here is really just to align that portfolio with your goals. As we think about kind of the summary of 59 and a half, some pitfalls to avoid. Don't withdraw too much too soon. Don't pay a huge tax bomb. And also don't deplete your retirement. But you now have the opportunity to tap this and do what I hope is some strategic things with it. Another kind of pitfall would be just ignoring healthcare until it's too late. Do not leave your job with no plan around healthcare if you're before 65. And then another thing to kind of take a look at too, double check the beneficiaries on all your accounts. Who your stated beneficiary is on an IRA, for example, will supersede the will. So just make sure you've got all that up to date and looking the way you want to. This is a great chance to just kind of dot your I's and cross your T's for your whole financial planning, including that estate planning stuff. Now, some kind of final action steps. So you just want to review those retirement accounts, think about kind of your tax bracket today versus the future. Good opportunity to talk to a financial advisor, see what you might be missing, see what kind of opportunities you have in the years ahead. I'm often surprised at how many clients we can just make easy wins for. For instance, you'll see people who are earning really high income in their late 50s, early 60s, only planning to work for a few years, and they are not maximizing, let's say, an HSA and 401k, and yet they're doing that saving into a taxable account instead. Well, a lot of times those same people in just a few years when they retire will be in a much, much lower tax bracket. So we want to optimize their tax deferred savings today. So there's a lot of easy wins out there sometimes that a good planner or a good advisor can kind of help you with. And, finally, just thinking through your overall planning with your RMDs, your Social Security, healthcare, all that kind of stuff that we've gone over today. So love to hear what kind of strategy you're looking at tackling today. Appreciate you tuning in for this video. Share it with anyone you think would benefit and like it and subscribe to my channel. Thanks.